Hey everyone, welcome back. I'm your mortgage specialist, and in today's episode, we are going to talk about three things every home buyer must understand before applying for a mortgage: fixed versus variable, how interest rate works, and the difference between pre approval and approval. By the end of this video, you will know which mortgage might suit you best, what affects your rate, and how to avoid the most common approval mistakes. Let's get started. Let's start with the basics: fixed versus variable rate mortgages. These are the two most common types you will come across. With a fixed rate, your interest rate stays the same for your entire term, usually 1 to 5 years. That means your monthly payments never change. This is great for people who like stability and want to budget easily without worrying about the rate hikes. Think of it like locking in the price of your morning coffee for the next 5 years. Even if everyone else pays more later, you pay the same. Now, a variable rate mortgage means your rate is tied to lender's prime rate, which moves with the Bank of Canada's policy rate. So, if the central bank lowers rate, your payments can go down, but if they raise rates, you could end up paying more. Variable rate can save you money when rates are falling, but they come with more uncertainty. Some lenders also offer adjustable rate mortgages called ARMs, where your payment stays the same, but how much goes to principal versus interest changes. So if rates rises, more of your payment covers the interest and less goes towards the loan balance. Let's take an example. If you take a $500,000 mortgage at 5% fixed for 5 years, your payment might be around $2,900 per month. With a variable rate starting at 4.8%, you could save around $5,200 a month. But if rate increases by 1%, your payment could go up to 3,000 or more. So the real question is, what's more important to you? Saving a bit now or sleeping peacefully knowing your rate won't change? Now that we have covered the types of mortgages, let's talk about the big one, interest rate, because understanding how rates is set can literally save you thousands. Your mortgage rate depends on a few key factors: the Bank of Canada's policy rate, lender's prime rate, the type of mortgage, fixed or variable, and your own financial profile like credit score, income stability, and down payment. For instance, fixed rates are influenced more by bond yields, like the 5-year Canadian government bond yield. When bond yields go up, fixed mortgage rates generally rise too. Variable rates, on the other hand, move directly with the Bank of Canada's overnight rate. So when the bank raises or cuts that rate, lender adjusts their prime rate and that affects your variable mortgage. In 2020, rates were historically low and variable mortgages were a huge win. But after 2022, when the Bank of Canada hiked rates to control inflation, many homeowners saw their payment rise by hundreds of dollars a month. So the takeaway, always consider where we are in the rate cycle and how comfortable you are with change. And yes, your credit score plays a big role. Someone with a score above 750 might get a 4.9% rate, while someone at 640 could get 6% or more. That difference could mean paying tens of thousands extra over your mortgage term. Before applying, check your credit, pay down debts, avoid new loans, and those steps can get you a better deal. Next is, now let's clear up one of the most confusing parts of the mortgage process: pre-approval versus final approval. A pre-approval is basically a conditional green light from a lender. It estimates how much you can borrow based on your income, credit, and debt levels. It's super helpful when you house hunting because it's give you a budget, show seller you are serious, but this is important. Pre-approval is not a guarantee. It doesn't mean you are 100% approved for that mortgage amount. The final approval happens after you have found a property, submitted a full application, and that's when the lender checks everything: your job letter, pay stubs, credit report, and even the property appraisal. They will also recheck your finances to make sure nothing's changed. So don't buy a new car, take a loan, or switch jobs between pre-approval and closing. I have seen cases where buyers got pre-approved but the deal fell apart because their financial situation changed or the property didn't meet lender guidelines. So think of pre-approval as your starting point, not the finish line. To wrap up, fixed rate mortgages is equal to stability and predictability. Variable rate mortgages is equal to flexibility and potential saving but more risk. Interest rates depend upon the economy and the bond yields and your credit profile. And the pre-approval is great, but don't confuse it with final approval. If you found this video helpful, give this video a thumbs up, share it with someone buying a home, and stay tuned.